Welcome back to The Explainer. If you've been looking at the charts lately, you know exactly what I'm talking about. We are operating in some absolutely extreme volatility right now. Honestly, modern markets can feel a bit like trying to navigate a minefield blindfolded. But today, we're taking that blindfold off. I'm going to equip you with our top-down investor toolkit so you can actually survive and maybe even thrive in this wild landscape.
All right, here's our roadmap for today. We're going to start with a May 2026 macro outlook, then drill down into a micro case study on ShareX. After that, we'll decode dollar share tokenomics and finish up with some essential risk management, specifically avoiding fundamental value traps and dodging those nasty dead cat bounces. Let's get into it.
Okay, let's dive into this. Section 1, the May 2026 macro outlook. So right now, geopolitical tensions are heavily dictating market sentiment. Whether we get long-term de-escalation or prolonged tension in the Middle East, that drives oil prices, which in turn drives global inflation fears, and ultimately decides if risk-on assets can even catch a bid. But that context in mind, just look at this timeline of catalysts hitting the market. We've got Consensus Miami wrapping up early in the month, which is great for narrative momentum, but then we hit a massive decision zone. May 8th hits us with the April non-farm payrolls. Then, May 11th is the absolute critical Senate vote on Kevin Warsh's nomination for Fed chair. And literally the very next day, May 12th, the April CPI inflation data drops. These back-to-back events make mid-May a total high-volatility minefield. So what's the actual playbook here? Well, the strategy is simple but absolutely crucial. You want to stay risk-on in early May to ride that conference momentum. But then you've got to transition to a highly cautious stance in mid-May, ahead of that orange vote and the CPI data on the 11th and 12th. You really need to be lowering your leverage, protecting your profits, and tightening up that risk management. Which naturally leads us to a massive question. As we shift our view from this broad macro weather down to the micro level, where is the smart institutional and retail money actually flowing in such a cautious, data-heavy environment? Well, let's take a look. Section 2, ShareX, a micro case study. Why is smart money like OKX Ventures paying attention to this specific project? Check out this number, $1.5 trillion. That is the massive global scale of the real-world sharing economy. And ShareX isn't just tokenizing T-bills or real estate. They are bringing the revenue from physical, shared devices, think power banks and EV chargers, directly onto the blockchain. That is the true narrative behind their real-world asset, or RWA utility. Now, what's really interesting about this slide is the actual infrastructure they've already deployed. ShareX isn't just another shiny white paper. They have the D-Share Alliance, which connects over 100 global brands. They've got verified integrations with major operators like YoPoint vending machines, and they're using Paid Out of Cloud for on-chain settlement. Plus, to drive consumer adoption, they've got a cool $1 million reward pool in their TreasureX Season 2 campaign. So they are literally connecting physical devices to the blockchain in real time. And that real-world traction is exactly why we saw an incredibly rare coordinated forex launch back on May 8th. I mean, look at these details. Dollar Share debuted simultaneously on LBank, KuCoin, MEXC, and Binance Alpha. Let me tell you, that doesn't happen by accident. It takes massive coordination. KuCoin even sweetened the whole deal with a $200,000 share airdrop specifically for KCS holders, which brought instant volume and momentum right from day one. Moving right along to Section 3, decoding share tokenomics. Let's see how the value is actually structured here. Let's break down the distribution of their 100 million total supply. Now, the lion's share obviously goes to mining, ecosystem, and the treasury. But pay close attention to the team and investor allocations. Combined, they make up 20 million tokens. What's absolutely vital to note here is that these insider allocations feature a strict 12-month cliff and a 24-month vesting schedule. This is a crucial structural guardrail designed specifically to protect retail buyers from early insider dumping. We love to see that. And this ties perfectly into their core philosophy, which is quoted right here: long-term engagement through verified real-world incentives. Look, a massive problem in Web3 is the airdrop mercenary. People who just show up, grab free tokens, and instantly dump them on the market. ShareX is tackling this by tying rewards to their Power Pass NFTs. You actually get rewarded for verifiable, sustained physical interactions with real-world devices. It's a smart way of turning short-term mercenaries into long-term network participants. All right, on to Section 4, avoiding fundamental value traps. Time for some serious risk management. So, the crucial point is, evaluating fundamentals correctly is literally everything. Why? Because there is a massive, highly dangerous difference between a genuinely undervalued asset and a value trap. A true bargain has stable or improving fundamentals, but its price is just temporarily depressed by market noise. A value trap? Well, that's a melting ice cube. It might look cheap, maybe trading at a super low multiple, but it's cheap because the underlying business is in structural decline. In those cases, the market is actually right to price it low. So how do you actually spot a trap? You need to watch for these fundamental warning signs. We're talking consistently declining revenue and shrinking margins, falling returns on capital, and heavy leverage, like net debt exceeding 3x EBITDA. Oh, and don't forget poor management that just keeps throwing bad money after worse. Remember, fancy accounting tricks can easily mask a lack of true free cash flow. If the cash isn't flowing, I promise you that low valuation is entirely justified. And finally, Section 5, dodging dead cat bounces. Let's talk about avoiding those false recovery rallies. Let's clearly define this rather grimly named trading concept. As the old Wall Street saying goes, even a dead cat will bounce if it falls from high enough. A dead cat bounce is a temporary, incredibly weak price rebound during a severe downtrend that quickly fails, leading to an even deeper crash. Why does it happen? Usually it's a mix of short covering, emotional retail traders rushing in to buy the dip, and large institutional whales intentionally pushing the price up just to hunt for liquidity before dumping their larger bags on the market. You absolutely 100% must know the difference between a true reversal and a trap. A real reversal prints higher highs, is backed by high and increasing trading volume, and sees the RSI break confidently above 50. A dead cat bounce? It prints lower highs, volume dries up as the price rises, and the RSI stays weak, firmly below that 50 midline. And this brilliantly illustrates the 4 specific red flags you have to watch out for. First, the ghost rally. Price goes up, but volume goes down. Second, the Fibonacci wall. The bounce completely stalls out at the 0.382 or 0.5 retracement levels. Third, look for bearish rejection candles right at the top, like a gravestone doji, which signals aggressive selling. And finally, an RSI bearish divergence, where price makes a higher peak on the bounce, but momentum makes a lower peak. Guys, market structure always trumps your emotions. So how do we actually trade this safely? Well, here is your concrete step-by-step action plan. Step 1, confirm the macro trend. If the price is below the 200 EMA, you assume it's a bounce, not a reversal. Step 2, identify where old support has turned into resistance. Step 3, sit on your hands and wait for that bearish rejection candle. Do not front-run it. Step 4, enter your short position below that candle's low. And Step 5, set a precise, tight stop loss just above the peak of the bounce. This is exactly how you trade a relief rally without becoming someone else's exit liquidity. We've covered a lot today, from macro trends and micro-level tokenomics to defensive trading mechanics. So as you look at your own portfolio today, I want to leave you with this. Applying the top-down toolkit you've just learned in this current, highly volatile market, are you investing in a true reversal, or are you just catching a falling knife? Keep learning, keep analyzing, and let the data guide your decisions. I'll see you in the next explainer.